Welcome to the Deep Dive. Today, we're cracking open the results from LiveOne Inc.'s Q1 fiscal year 2026. That's the quarter that ended June 30th, 2025.
Right, and it's all based on their recent earnings call.
Exactly. Our mission today is really to look at how management is, turning things around after that significant revenue loss. We want to see how they're using B2B, cost controls, and, these newer things like Web3 and live events to reposition.
Yeah, reposition for potentially some major growth. It's that shift, isn't it? From defense to offense. That's the real story here.
Definitely. You can't really talk growth until the base is solid.
You really can't. And the steps they took to stabilize things, financially speaking, were absolutely critical, especially after the challenges, the structural ones they faced last year.
Okay, so let's start right there with that foundation, because the financial cleanup seems, pretty rigorous.
It really does. They managed to stabilize the balance sheet. That $7 million short-term loan from East West Bank, the one that got called in, they replaced it with a much larger $16.5 million facility from JGB.
Okay, that swap alone must signal some confidence from, institutional money.
Huge confidence. And then they doubled down, confirming they closed a $10 million equity financing deal.
Right.
Add that to what they had, and LiveOne's sitting on over $20 million in cash. Management's calling it their strongest balance sheet in years.
And it wasn't just about piling up cash, was it? They were also cleaning up the other side of the ledger.
Exactly. Scrubbing it clean. They cut short-term liabilities by, $14 million total.
14 million, yeah. And $2.5 million of that just this quarter alone. That's key for clearing the decks.
It is. And we have to talk efficiency, too. The staff restructuring.
Right, the cut.
A 31% cut in the workforce, dropped from 138 employees down to 95.
Wow.
But what's really interesting, I think, is where those cuts happened. A big chunk was in the Slacker technology team.
Cutting the tech team in a tech company. That feels like a gamble unless there's something else going on.
Well, it seems like a declaration, really. Management basically said it was possible because they're adopting proprietary AI.
Ah, AI.
Yeah, they're using artificial intelligence now to curate their 500 music channels. So it's not just saving on salaries, it's like a vote of confidence in their own AI.
Seeing the AI could do the job just as well, or maybe even better.
That seems to be the message, making human oversight less necessary. It's a pretty powerful signal for how the whole audio industry might start using AI for, leverage.
Okay, so foundation looking solid, maybe even AI powered now. How do they actually pivot from just being stable to aggressive growth?
Right.
Where's the rocket fuel coming from?
That pivot seems to be all about the B2B engine, and it sounds like it's already, firing on multiple cylinders.
Okay.
Management's guiding towards $50 million in B2B revenues. That's over the next 12 months, covering both Slacker Music and Podcast One.
50 million. And their big existing deals, they're doing well, beating expectations.
Seems so. They confirmed that Amazon deal, the $16.5 million 3-year one. Management expects to actually exceed those numbers.
Good sign.
And similarly, that partnership with the Fortune 250 streaming network, it's now valued at over $26 million, and they think it'll climb higher by the end of the year.
But the real buzz seemed to be around this massive new Fortune 500 partner launch. Management kept calling it the biggest launch in their history.
Yeah, that's the potential game changer. They're talking about it driving them to maybe over 30 million paying subscribers.
30 million? How?
Okay, so we need to unpack the mechanics here a bit. It's a white label solution.
Meaning
LiveOne built the tech, but the Fortune 500 partner puts their brand on it. Management used the phrase Intel Inside.
Ah, right. So LiveOne provides the engine.
Exactly. And the Fortune 500 partner handles the huge marketing spend and is heavily invested in making it work.
Okay, so that de-risks the whole subscriber acquisition cost for LiveOne. They get the recurring revenue without that massive marketing bill.
That's smart. It's a huge structural advantage, potentially. And the conversion mechanism is key, too. They compared it to how Disney launched with Verizon.
Where the partner helps pay for it makes it easy to sign up.
Yeah, it makes the opt-in super simple, like just pressing a button. It takes that whole customer conversion burden off LiveOne. It's all about scale.
That potential volume is massive. And the pipeline behind all this isn't empty either.
No, not at all. They highlighted 75 additional B2B deals are in the works.
75, wow.
Yeah, it's a huge number. And they're targeting everyone.
Yeah.
Carriers, card companies, retailers, cable networks. It signals, sustained momentum, not just one big hit.
Okay, let's shift gears slightly to content monetization. Podcast One specifically. That seems to be scaling really well.
It really is. Record revenues for the quarter, $15 million. That puts it on an annualized run rate over $60 million.
60 million plus. That's incredible growth considering where it started.
Definitely. And meanwhile, they're clawing back that lost Tesla audience. Remember that restructuring?
Yeah, that was critical.
Well, they've managed to convert 1.3 million users out of the 2 million cars back into free or paid services. That's like a 60% recovery after that revenue loss hit.
Okay, and that connects to ARPO, right? Average revenue per paying user.
Directly. The blended ARPO, what they make per paying sub, is jumping from $3 up to $5.
$3 to $5. That's a big jump.
It's a 66% increase, yeah, driven by these better B2B deals. And management sees a path to push it even higher, maybe up to $7.
Wow. More B2B deals and rate hikes.
Exactly. Those new high-value partnerships, plus they're anticipating future rate increases, kind of like we've seen from Spotify and others.
And this ARPO increase, it's helped by their ad strategy, too. They mentioned a new partner, DAX.
Right, DAX, the largest programmatic advertiser. That partnership apparently boosted ad growth in Tesla cars from 30% up to 82%.
82% growth. So is the goal just more ad dollars?
Well, yes, but it's cleverer than that. They're using the current ad load, which brings in about 50 to 60 cents in ARPO per user, not just for the revenue, but as a tool, a lever to drive paid conversions, offer a better ad-free experience. And they're aiming to convert 20% to 30% of those free users to paid over the next year or two.
So the ads actually help sell the subscription. A flywheel.
Exactly. A content flywheel powered by ads.
Okay, before we get to Web3, we should touch on that video content monetization. That seemed almost like a new, unexpected revenue stream.
Yeah, selling those true crime shows, Burnham Town, Vigilante, Opportunist to major networks, netted nearly $1 million up front.
And management stressed this was basically pure profit, right? Using existing IP.
Pretty much. Pure cash flow, they said. And they have a whole slate, over 20 potential shows lined up from their archive.
So potentially millions more in revenue with basically zero extra cost, turning old content into a new profit center.
That's the idea, a profitable little media production arm almost.
Okay, now let's talk optionality. Starting with live events, they're relaunching big time with this Reality Olympic series.
Yeah, this sounds ambitious. They're calling it their biggest live event since Social Gloves.
And Social Gloves was huge, wasn't it? Like $27 million revenue, $4.5 million EBITDA in one night.
Something like that, yeah. And the scale this time sounds even bigger. Reality stars with, 275 million combined followers, projected to hit over 400 million.
Massive reach. And how do they make money from it?
The usual suspects. Pay-per-view, but also VR elements, music, and they specifically mentioned a very sizable NFT element.
NFTs again. But the main goal isn't just the event revenue.
No, again, it seems the primary goal is leveraging it all for the subscriber base and their data flywheel, feeding the core business.
Which brings us neatly to their digital currency strategy.
Yeah.
That $10 million they just raised in equity.
Yeah.
It's not just sitting in the bank.
Yeah.
It's earmarked for a Bitcoin yield treasury strategy.
Okay, unpack that. Bitcoin yield. Treasury strategy.
They claim it's a managed account, aiming for a 12-15% annual return, but importantly, they say it's protected using an option strategy to hedge the downside risk.
12-15% is obviously attractive. But wait, they just stabilized the balance sheet, right? Raised $10 million in fresh equity.
Yeah.
And now they're putting that critical cash into a digital asset yield strategy, even with options. Isn't that incredibly aggressive? Doesn't that risk undermining that investor confidence they just rebuilt?
It's definitely a high-risk, high-reward move. But the key thing management kept stressing to mitigate that is the NOL, the net operating loss.
The NOL. How big is it?
Massive. $110 million.
Okay, that is the essential context then, because an NOL that large means any cash flow from that yield strategy or any profit the company makes for a while.
It's effectively tax-free until that $110 million loss is used up.
Right. Which makes the returns from the Bitcoin strategy basically usable cash immediately. That does significantly shift the risk calculation. Makes it less about the risk to principal and more about the immediate cash flow potential.
And backing up this whole Web3 push, they've brought in some known Web3 leaders.
To do what specifically?
To monetize their massive video archive, 10,000 plus hours using tokenization and NFTs. They mentioned some past content already generated $5 million in NFT money.
Interesting. So they see real potential there.
Apparently. And they promised a public announcement on the whole Web3 strategy, the treasury details, the NFT plans, Within 72 hours of the call.
Within 72 hours. Okay, that's a major immediate catalyst for investors to watch.
Definitely. Let's talk about that investor context now. Management was pretty open about signaling M&A potential.
Yeah, they confirmed working with JP Morgan, mentioned lots of inbound calls about mergers, acquisitions, maybe selling off a subsidiary.
And the valuations they cited for competitors, Napster and Tidal, seemed designed to make a point.
Oh, absolutely. Napster selling for $210 million on just $40 million revenue, Tidal for $400 million, neither profitable. They're clearly trying to reset market expectations for LiveOne's own value.
The argument being that big tech and distribution companies need an audio platform like theirs.
That's the thesis. Facebook, Microsoft, Walmart, major carriers. They argue these giants have a strategic gap that a proprietary content and audio platform like LiveOne could fill, especially to stay competitive.
And based on all this momentum, they set a pretty ambitious long-term goal.
Very ambitious, hitting 10 million subscribers and $500 million in revenue within, what, 3 to 5 years?
Yeah, 3 to 5 years. That's a huge leap from where they are now.
It is. But importantly for investor confidence, they're backing up the talk with action, the share buybacks.
Right. They bought back over 300,000 shares this quarter.
And still have $5.5 million left on the buyback authorization. That signals management genuinely thinks the stock is undervalued right now.
Okay, time for our not financial advice segment, where we pitch an outrageous but plausible trade idea purely based on these high momentum catalysts we just discussed.
Right. And this setup feels almost tailor-made for it. You've got two potentially massive catalysts dropping, maybe within days.
The official name of that Fortune 500 partner.
And the full details of that protected Bitcoin treasury and the NFT monetization plan, both are imminent, according to management.
So it sets up a classic kind of binary high conviction momentum play.
Exactly. So the trade idea, it's a short-dated, highly leveraged synthetic long position.
Okay, break that down.
Basically, you're making an aggressive bet the stock price is about to jump significantly. You'd use deep out-of-the-money call options, buying the right, but not the obligation, to purchase the stock later at roughly today's price. You want maximum leverage for a quick, sharp move upwards.
And the rationale is that the market hasn't priced these catalysts in yet.
That's the bet. That the combination of naming a blue chip partner, which validates that $500 million revenue target, plus revealing the details of a protected, high-yield digital asset strategy, that combo will force institutional investors to just scramble to aggressively re-rate the stock almost overnight.
You're betting on at least a 50% pop in the stock price.
Minimum. Banking on that combined excitement causing a rapid repricing before the wider market fully digests it. It's really a risk-on bet on management delivering these announcements immediately and effectively.
Okay, well, there you have it. A very specific, very high-risk idea based on imminent news flow. So recapping the core story.
LiveOne seems to be making a significant pivot, moving away from that tough financial spot towards a strategy built on B2B momentum and, well, high optionality with Web3 and events.
Yeah, the key takeaways really seem to be that fortified balance sheet providing the base, and then this massive, potentially de-risked growth from the Fortune 500 deal, layered with the whole Web3 integration play.
And if we zoom out for a final thought, you consider the pipeline 75 B2B deals, plus the focus on monetizing all that video content, which could be incredibly valuable for training AI models, right?
Interesting angle.
It raises a question for you, the listener. Thinking beyond the usual suspects management mentioned, what non-traditional media company or maybe even a major tech player focused on AI or search might be looking desperately right now for exactly this kind of proprietary large-scale content and audio platform to acquire to fill their strategic gap in the coming AI race? Something to chew on after digging into these results.